All right, everyone, we're going to go ahead and get started. My name is Stephen Jenkins. I'm a life sales director over here at IAMS. I want to thank you all for joining the call today. Later, we'll have Nationwide on here to go over some helpful ideas when it comes to tax planning with your clients. But first, before we get into the main event, I did want to take a couple of minutes to chat with you about some additional ways IAMS is here to help add value to your business. So, first up, we've got our new producer program. And as you can see up there, there's a couple of different option point totals from 100,000 to 1 million. And in your first 6 months with us, you automatically get enrolled into our new producer bonus program. You can see there's a variety of different options that you can cash out at, whether that's marketing programs, marketing dollars, cash trips, etc. If you have any questions on that or would like to know a little bit more, just reach out to a sales director here. That number is 800 255 5055. In addition to that, we've got our referred producer program. If you know of an agent who maybe isn't quite happy with their current IMO relationship, or you think that they might be a better fit over here, send them our way. Not only will you get a bonus when you first get contracted, but then on an ongoing basis, you'll receive a bonus based off their production. You don't have to do anything. We'll take care of all the service and support for the agent. This could be a great way for you to earn an additional revenue stream. And in addition to that, we do have our standard marketing reimbursement program. As you can see, that's $100 for every $100,000 of index annuity premium. And then on the life side, it's $200 for every 100,000 of single premium life and $200 for every 10,000 of life target. Again, if you'd like to know more about this, just reach out to a sales director here. That number is 800 255 5055. Back office support. I do want to touch on that for a moment. It's the cornerstone of IMS for the last 38 years. Whether that's pre-sale illustration design work or pre-underwriting, the submission to commission process, our team does an amazing job. So if you haven't tested us out just yet, I do encourage you to do so. As well as our IMS website is a wealth of information. We have sales tools, our IMS portal. There's just a ton of information. You will not get bored going out there. And you don't need to be contracted with us to access this either. We've got our quoting system out there for annuities and life insurance. We've also got our current rates. In addition to that, we have our e-app platform, product information, and underwriting information. We have our sales resource library out there, which has hundreds of point of sales pieces. Out there, you can instantly download just about any topic you can think about talking to a consumer about. If you have any questions while you're out there, feel free to reach out to one of the sales directors. I know that we have pretty good access of it and pretty good knowledge of the websites. We can point you in the right direction. I do want to mention that our portal does integrate with all the standard e-app platforms, so Firelights, iPipeline, as well as Sunfire on the Medicare side. If you're curious about what carriers do integrate, we do have some cheat sheets that we can get sent out to you. So reach out to one of your sales directors here at Times, 800 255 5055. Our creative marketing team, and creative really is the key word here, they work on a variety of projects for a number of agents across the country that are in different phases of their career. They do an excellent job when it comes to really taking the idea that you have and bringing it to life. They also have a very big focus on brand. As you may know, branding has really evolved over the last few years. And if you really look at it, it's how the marketplace has really put a great importance on your digital brand. We have more and more agents who are doing virtual sales and consumers who are doing more research online. So if you don't have a real robust digital brand in addition to your local market space, it can definitely impact your business. If you have any questions on this or on our creative services, reach out to one of the sales directors. But I am curious for those out here. I'm going to launch our first poll question, which is, are you currently using any of IM's creative services? Let me go ahead and get that poll question out here launched. And let us know if you're currently using any of IM's creative services. All right, finishing up the last couple votes here. I do see that a number of you are not, so I do encourage you to go out here, take a look, talk to a sales director, and let us know how we can, what we can do for you and how we can do it with our creative team. As you may know, that we launched our RAA several years ago, and we've seen significant growth in our wealth management side. If you've been thinking about adding AUM to your business, or you have it here, maybe you just got your 65 recently, or you aren't quite happy with your current RI relationship, I do want to launch our second poll question here, which is let us know if you're interested in learning more about our wealth side of the business, our IAMS wealth management. You click yes here, then we'll have someone from the team reach out to you to just chat more about some of the services that they provide. Even if you're interested in getting your 65 or adding this to your business, I do encourage you to check yes and have this conversation with our team. Alrighty, get that poll question closed out here. Next up, we have our Life and Annuity Academy. In fact, we just had a great group of agents here in the office last week. Unfortunately, I do believe that that's the last one of the year, but these events are an amazing opportunity for you to spend some time working on your business. It's not easy to do that when you're out in the field, running the business, meeting with prospective clients, dealing with other IMOs, carriers, etc. But these academies really are a great opportunity for you to spend some time working on your business with a bunch of like-minded individuals. Reach out to a sales director if you'd like us to give you some more information. I know that all the rest of them are going to be in 2025, so you want to try to put this on your calendar now so that you have it going, some awareness going into it for next year. Our Quebec trip qualification has been underway since the beginning of this year. Keep in mind that production between January 1st and June 30th of 2025 will count towards qualifying. If you would like additional information or to see where you're currently standing, reach out to one of us sales directors. And lastly, I do want to make sure that you are following us on Facebook and LinkedIn. We do syndicate a lot of our content out there, whether it's product changes, marketing ideas, what's going on in the industry. This is one of the best ways to keep up to date with us. So with that, I do want to jump this over to our current presentators nationwide. So we have a couple great resources here with Sharlene and Allison. I do want to thank you all for joining, and let me hand over the reins.
Awesome. Thank you, Stefan. This is Sharlene Woerther. I'm one of the RVPs for Nationwide. I appreciate you all taking some time this afternoon to meet with me and Allison. We're going to go over estate tax planning 2024 and beyond. So hopefully you'll pick up a few tidbits here that can help on your planning going forward. Before I turn the reins over to Allison for the presentation, I'll give you a quick intro. She's one of our advanced marketing attorneys. I should say advanced markets attorneys. Let me get that right, Allison. And she's been with Nationwide for a little bit over 6 years now, I believe, Allison.
That's right.
Awesome. And we're thrilled to share this with you. We know there's a lot going on in this space. There's a lot of conversation. So we wanted to bring this to you all today. Before we get started, Allison, are you up for a little bit of numbers game?
All right, Sharlene, let's do it.
You're in. Awesome. All right. Since I believe we have a lot of folks on the call, they're muted. You guys can use your chat box, I do believe. So throw that in, or we'll throw some numbers and you can kind of think about them, and we'll get started. All right. So as we think about estate planning, what does the number 40% mean to anyone on the call? If they want to throw it in chat, or we'll let Allison answer. 40%.
Yeah, I'm not able to see the chat, I don't think, but if folks want to type into the chat, go for it.
Awesome.
We have somebody that said taxes.
There you go.
Be more specific.
State taxes.
State taxes?
40% estate taxes after January 2026.
Okay, well, actually, that is 40% is the current effective gift and estate tax rate. That is not going to change, actually. in 2026. It will remain 40% under current law.
Awesome. All right. The next one for the group is 458. 458. Any takers on that one?
Any
Nope,
chatter, Stefan?
Stumped them.
Section 458, days before probate completes.
Well, that was creative.
Yeah.
Looking to a tax section code. There are 458 days until January 1st, 2026, the quote unquote sunset.
Love it. All right, next one is 27.22 million. 27.22 million.
It's a big number.
Any bites on that one, Stefan?
Inherited assets.
I wish.
Current cap. That's what's in your bank account. In the future, it'll be 13.67 million.
Ooh,
We're getting
close.
there.
Yeah.
27.22 million is the amount of money a married couple can gift this year without any gift tax consequences, because the state tax exemption this year is 13.61 million per person. Double that, you have 27.22 million for married couples.
Awesome. All right, next up is 18,000. 18,000. Much smaller number than 27.22, but still important.
I'll take it. That'll fix my air conditioner.
Right.
Allowable gift money each year. Annual gift tax exemption.
Very good. That is the annual exclusion from gift tax this year. It's a per donee number, so you're able to give several people $18,000, and it would not count against your gift tax exemption. And a married couple would be able to make $36,000 gift, 18,000 from each spouse without gift tax consequences.
Awesome. All right, our next number up is 1492. 1492. This is one of my favorites.
Don't have any takers on this one.
Allison?
1492, Columbus sailed the ocean blue.
Please make sure everybody's paying attention there. No, I love it. That's great. How about 60,000?
60,000 when it comes to estate planning. Let's see if anyone has any guesses on this.
No
See that
takers on
Scott has
60.
raised his hand, but nope, no guesses.
60,000, that is the state tax exemption for a foreign national. If you're a US citizen or permanent resident, you get the $13.61 million this year. If you're a foreign national, you only get $60,000 exempt from the US estate tax.
Nice. All right, the next one is two numbers, or well, a number and a percentage. So I have 5 million and 16%. 5 million
and 16%.
Mhm. Any takers?
You have a bunch of East Coast people on your call, Stefan. In the New England area, these numbers might be familiar.
I just see some people raising their hands. You can put those answers over into the question box, and we'll see it there. But state to state income taxes.
All right. That is $5 million is the state estate tax exemption in Vermont. And 16% is the state estate tax rate in Vermont. And what makes Vermont unique is that that $5 million exemption is not indexed for inflation, and the 16% is a flat estate tax. So something to watch out for with your clients in Vermont.
Nice. All right, we've got two more here. So our second to last number is 185,000. 185,000.
This is another number that has an international flair to it. 185,000.
No takers.
Right? Well, 185,000, this is this year's enhanced annual exclusion gift to a non-US citizen spouse. We went over earlier the $18,000 per donee annual gift tax exclusion. If that gift recipient is a non-US citizen spouse, the number is actually $185,000 this year.
All right, last question for the group. 90,000. 90,000. Nobody knew they were going to have to play math games.
Question on that last one they asked, is that from a U.S. citizen spouse?
Doesn't matter who it's from. It's any U.S. asset that is gifted to a non-U.S. citizen spouse. Good question.
Mm-hmm.
90,000 is the last estate planning number.
No takers on that one?
Nope, no takers.
No takers. All right, Allison, it's yours.
Sure, 90,000 is the amount that you can max fund or super fund a 529 plan with this year. You are allowed to get up to 5 years of annual exclusion gifts into a 529 plan in 1 year without any adverse gift tax consequences. So that $90,000 figure is the $18,000 annual gift tax exclusion times 5. That gives us 90,000. So thank you, Sharlene, for running through those numbers, and Stefan for watching the chat box and the Q&A box. And I hope that's got us in the estate planning mode. I'm happy to be here today to talk with you a little more about estate tax planning with ILITs, irrevocable life insurance trusts, 2024 and beyond. Here's Nationwide standard disclaimer slide. We don't provide tax or legal or investment advice. Your clients always has to get that from their own tax, legal, or investment advisors. So the most important part of this presentation is the first bullet on the background on the estate tax, who your prospects are going forward, and the need for irrevocable trusts. After we go through that part, I'm happy to pause. And Stefan, if you'd let me know if there's any questions or comments that have come in, I'll be happy to pause there and see what folks have to say. And then we'll look at what is an irrevocable life insurance trust, or ILIT. And I'd propose to you that there's actually 3 different types of ILITs that I found financial professionals mean when they say the word ILIT. And we'll see how far we get through a very important topic, funding the ILIT. So we'll start off first with some background on the estate tax and hopefully help you identify your prospects going forward. All right, so what is the estate tax? It's a tax on your right to transfer property at death. And that tax is imposed on a deceased person's estate. It is basically your net worth at your death. It's the value at the time of your death of all of your property. And your estate is responsible for paying the estate tax in full, generally within 9 months of death. An estate tax is not an inheritance tax. This is not a tax that your heirs have to pay. This is a tax that the deceased person who's no longer here, but they're legally still here as far as their estate is concerned, it is a tax imposed on the estate. And this is also not merely a tax on death. Folks are not taxed merely because they pass away. It is a tax on everyone's right in this country. We did a little international flair in our numbers section. Not all countries recognize property rights the way the United States does, and not all countries allow a person to dictate what happens to their property after they are no longer here. So it's not a tax on death or dying, it's a tax on our right to transfer property at death, and all the court system and all the other public systems that are set up to allow that to happen. Now, we've mentioned in our numbers game the exemption. We've said that word, the exemption, because not many people end up actually paying any estate taxes. In our law for hundreds of years, there has been an amount exempt from the estate tax. This is the amount of money that individuals are allowed to pass on estate tax free. Now, to the extent an estate is worth over the exemption, the federal estate tax rate is essentially a 40% flat rate for amounts that are above the exemption. Now, this year, the exemption is $13.61 million per person. It's never been this high ever. Double that, you have $27.22 million for those married couples. But you're probably well aware by now, in 2026, I think it was about 458 days, in 2026, the federal exemption will essentially be cut in half. It's going to be lowered to $5 million indexed for inflation. And the best numbers I can give you from what I've read and what I've heard people are saying is that in 2026, the federal estate tax exemption will be roughly $7 million per person, double that for married clients. So when we are prospecting and speaking with clients about the need to do some estate tax planning, we're going to be able to talk to a lot more people. We're going to be able to talk to single individuals that are worth over $7 million and married couples worth over $14 million. Whereas today, if the sunset did not happen, we would only be talking to single individuals worth over $13.61 million and married couples worth over $27.22 million. So there's a chance that some of your clients without estate tax exposure today will have estate tax exposure in the future with the sunset of the exemptions. And don't forget about your clients that live in a state that imposes its own state level estate tax. And those states are represented in blue and the one state in purple on this map. Those states in blue and purple impose a state level estate tax, and many of them kick in at levels much lower than the federal exemption, with the worst place to die in 2024 from an estate tax perspective being Oregon, which has only $1 million of an estate tax exemption. State estate taxes don't pack as much of a bite as the federal estate tax because the top estate tax rates are only 18 or 20%, so less than half of the federal estate tax rate, but something your client should be made aware of and planned for if appropriate. All right, so what's life insurance's role in all of this? Well, permanent life insurance can provide the liquidity to pay any estate taxes that are owed by the insured's estate. And I have to put that word permanent in there because I've spoken with one too many attorneys in the last 12 plus years of doing this who put term life insurance in irrevocable life insurance trusts. And it's not my job to give legal advice, but that is a potential recipe for a future lawsuit. The only product that can be there, in my opinion, the only product that can be designed to be there when your client dies at life expectancy is permanent life insurance. So to me, an estate tax plan is only with permanent life insurance. And that can provide the liquidity to pay any estate taxes that are ultimately owed by the insured's estate, and recall, oftentimes payable within 9 months of death. But the problem is if any of our prospects who are exposed to the estate tax personally own their life insurance policies, a large portion of that death benefit will be lost to the estate tax. It's like they're naming the IRS as a 40% primary beneficiary. And that is not great planning, again, in my opinion. So the solution for our prospects that have potential estate tax exposure is to have their policies owned by an irrevocable trust. And a trust that is set up, it's kind of a one-trick pony, if you will, to just pay federal estate taxes, we call an ILIT, an irrevocable life insurance trust. It's probably one of many trusts in the estate plan of the high net worth. And when we talk of the irrevocable life insurance trust, we think of it, its job is to help pay future estate taxes. Now, how do ILITs actually facilitate payment of the estate tax? It may not work like you think it does. It's not as simple as the trust getting a death benefit and paying the IRS. That's not a good plan, and that's not how the majority of estate planning attorneys would have things happen. So let's take a look for the visual learners. Imagine you have a prospect who is very wealthy, and at her passing, let's say she passed this year, her estate generated $5 million of estate taxes because at her death, she owned very valuable assets, classic cars, artwork, stocks, and bonds that were above the exemption, and 40% estate tax rate above the exemption. She owes $5 million of estate taxes. Now, her executor has a very difficult job because there probably isn't a savings account out there with $5 million of cash in it for the estate tax to get paid within 9 months. So the executor oftentimes finds him or herself having to sell estate assets to generate the cash to pay the estate tax. And if he wants to sell the classic cars, there could be objections from a nephew who loves cars and really wanted to add those cars of his aunt to his collection. And if the executor wanted to sell artwork to raise the $5 million of cash, there could be objections from the niece who is an art history major. And if the executor wanted to sell stocks or bonds, you could have objections from the investment professionals who spent their careers putting together that portfolio. So although this person was very wealthy, her executor is put in the unadmirable position of figuring out where to get the $5 million of cash. Now, a financial professional like yourself who encouraged your client to do estate tax planning with ILITs can come in as the hero for the executor, because you can let the executor know, hey, we put together a trust, an irrevocable trust with $5 million of life insurance, a $5 million life insurance policy, and there's $5 million of cash sitting in this trust. And the executor is very relieved. What actually happens at this point in time is that the trust goes shopping essentially with those $5 million of life insurance proceeds. It basically says, what can I use this cash to buy from the estate? It's like the $5 million is burning a hole in the trust's pocket, and the trust will use the life insurance proceeds to buy assets from the estate. The estate executor is happy to sell those assets to the trust. Essentially, it's moving them from the left pocket to the right pocket, from the heirs of the estate to the beneficiaries of the trust, who are all this deceased person's family. So the estate decides to sell some stocks and bonds to the trust and has raised the $5 million of cash necessary to pay the estate tax within 9 months of death. And the investment advisor is probably pretty happy because their portfolio can stay intact. They just have a new client. Now their client and the owner of the portfolio and the stocks and bonds is going to be the trustee. Now, how do you do such great planning for your clients? You use your resources. And if you work with Sharlene and my team at Nationwide, we have some great resources to help you and your clients do this type of planning. We have a white paper that tracks the remarks in this presentation. We have an estate planning fact finder that helps your clients figure out what their current net worth is, because we can put that information from the estate planning fact finder into our estate tax projection fact finder, so you can tell your clients potentially what type of estate tax they may be facing in the future and purchase an appropriate amount of life insurance to help pay for it. We do have access to a great software program called Number Cruncher. And if you do use our estate tax projection fact finder, we're able to put that information into the software, and you're able to have a conversation with your clients and tell them, Mr. Client, this year you're worth $9 million. If we assume that your net worth grows at 3% over your remaining life expectancy, it's likely you're going to be worth $25 million in the future in 2057. And that means you could face state tax exposure to the state of Massachusetts and federally in excess of $5 million. So a number cruncher report's a great tool for you to have a conversation with your clients to see what type of life insurance planning they're able to do today. All right, Stefan, I will pause here to see if there are any questions or comments that have come through, and to give people some time if they want to ask any, and type them in now.
Yeah, so the first one says the estimate on the street is $5 million. It's taken from 2007 before the TCJA adjusted inflation per Social Security number.
That is incorrect. The basic exclusion amount is a flat number that's indexed for inflation. It doesn't, I don't know, I'm not a Social Security expert, but everything I read about the estate tax, it never mentions Social Security. It's actually inflation adjusted based on 3 different years. It's 2016 and 2 other, the year before, 2025 and 1 other year. So it's base 5 million indexed for inflation, and the inflation adjusted number that I've been reading is about 7.
And another question says, can an annuity be structured similar to ILIT in a case the client won't qualify for life insurance?
I am not an annuity expert. I do know that some annuities can pay death benefits. Is that going to give you enough bang for the buck to plan for an estate tax? I don't know enough about how the leverage an annuity can provide. Sharlene might be able to get you in touch with someone on our annuities advanced sales team, and I would say run that idea by them.
And those were the only 2 thus far.
Yeah, good questions. Feel free to ask some more. After that first section, I hope you have a better understanding of what the estate tax is and who faces more likely exposure if the sunset does happen, and understand that in the law today, it's happening. There actually has to be an act or some affirmative action to stop it from happening. So we all have to pay attention, stay tuned. You know, there's an election coming up this year. Anything can happen. So this is a very live situation.
And
All
another
right.
one rolled in here
Yeah,
and asked,
great stuff.
what are the nationwide code numbers on the 3 forms you had just a moment ago?
Oh, Sharlene, are you able to share those forms so we don't have to go through all those ERBO numbers?
Yes, absolutely. I'll get those over after the call. Thank you for asking. Those are great tools.
Yeah, and Sharlene and Stefan, we can most likely circulate these to the attendees so that they have them. All right, very good. Let's take a look at the second topic, which is what's an irrevocable life insurance trust? And when I'm on the call with advisors and they're describing the estate plan and they use the acronym ILIT, I've learned that it can really mean one of 3 things. It can mean what I call the pure ILIT, which is all about death benefits for estate taxes. It could mean what I would call the survivorship SLAT, where not only is the policy positioned to pay estate taxes, the advisor's also thrown in the benefit of cash value access. And thirdly, when I hear the acronym ILIT, it could just mean a single life SLAT, which actually has really nothing to do with the estate tax, but you've sold a policy for tax-free income to someone who has estate tax exposure. So let me tell you a little bit more about each of those ILITs that I come across when I do my case consults. The one that's most applicable to today is this one. This is where I would keep my planning clean if I were an advisor. I would be talking about the pure ILIT. And this is an irrevocable trust that is designed to own life insurance for the sole purpose of paying the estate tax of the trust's grantor and spouse if married. This trust's and this policy's purpose is singular. Its purpose is solely to pay the estate tax. And if you're married, most of the time the estate tax is deferred to the death of the surviving spouse. So if you're married, what is often recommended to be put in ILITs is a survivorship policy. So a policy that only pays a death benefit after both insureds pass away. For single people, for people who are never married, for people who are divorced, and even for some widowed people, we're looking at a single life policy. But the pure ILIT is a one-trick pony. And if you look under the hood of a pure ILIT, how is it designed? Well, the grantor, the person who creates the trust, the person who's the insured, this person's often your client, that person and his or her spouse is not a trustee. Ideally, we're dealing with an independent trustee, someone who's not related or subordinate to the grantor or spouse. And a lot of times we see a child serving as trustee. There's nothing wrong with the child serving as trustee. It's just that things can become kind of messy based on that person's judgment and relationship with the grantor and beneficiaries. And when it comes to the pure ILIT, the grantor and the spouse, they're also not trust beneficiaries. There's really no reason for them to be trust beneficiaries when the only purpose for the policy is to pay estate taxes. Really, no one's going to benefit from this policy during their lifetime. But who you typically do see listed as trust beneficiaries are the grantor's children and more remote descendants like grandchildren. And if you've heard of the so-called crummy powers, the grantor's children are also typically granted withdrawal powers in the trust, the so-called crummy powers, which allow gifts to the trust to qualify for the gift tax annual exclusion. So that's what your typical pure ILIT looks like. Now, sometimes when advisors sell this concept, they go a step further. I would throw a little caution to this design because it definitely complicates the trust drafting and administration. But sometimes you tell them not only will this policy pay your estate tax is in the future, but you can have access to the cash during your lifetime. And now you've just sold them the survivorship SLAT, right? When we're dealing with a married couple, the SLAT acronym stands for Spousal Lifetime Access Trust. And in this trust, the survivorship SLAT, this is an irrevocable trust designed to own a survivorship policy for the dual purpose of paying the estate tax, in addition to allowing access to cash value. So you've sold them on two different features here. And because you've done that, the trust has to be drafted a little differently. Still, the grantor or spouse will not be typically a trustee of the survivorship SLAT, just like with a pure ILIT. Again, ideally, we'd like to see an independent trustee of the survivorship SLAT, someone not related or subordinate to the grantor spouse. But a lot of times we do see children serving as trustees, and they can also serve as a trustee for the survivorship SLAT. The big thing that distinguishes the survivorship SLAT from the pure ILIT is that we've added the grantor spouse as a discretionary trust beneficiary. Okay, we're still not gonna add your client, the grantor, as a trust beneficiary, but what makes this a SLAT is that the grantor's spouse is a discretionary trust beneficiary. Because what can happen is the trustee can access cash value, share those monies, distribute them with the grantor's spouse, and then the grantor's spouse can share that with the grantor. So the grantor retains indirect access to cash value through a spouse. So that's really the hallmark of the survivorship SLAT. Again, this will require a more intricate trust document, and trust administration should be overseen by an attorney so that no missteps happen. Personally, I like to keep my planning clean, as I mentioned it. So I would favor the pure ILIT over the survivorship SLAT. And lastly, the third type of ILIT that advisors talk to me about really isn't about estate tax planning. It's about future tax-free income. And that will called single life SLAT. And whoops, I went over my definition. The single life SLAT is an irrevocable trust that's designed to hold a single life policy that ensures the trust's grantor for the primary purpose of providing the grantor future tax-free income. Again, this is a sale that you've made, you've gotten the grantor excited about getting tax-free income from a policy in the future, but this person has estate tax exposure. So we ideally don't want them owning this policy personally. Trust ownership is the great solution from an estate tax perspective. And by designing the trust as a slat, we can still indirectly get the grantor the tax-free income. And the only difference between the survivorship slat and the single life slat is really the type of product that's being used. The single life policy is typically the most efficient for growing cash value for future tax-free income. The grantor spouse is the discretionary trust beneficiary here as well. So those were the 3 different types of ILITs that I've run across when helping you all do planning for your clients. For this presentation, I'm a big fan of the pure ILIT. Let's keep our planning pure. We can put a survivorship policy in this trust, and maybe we'll do a separate policy for a single life slat. When you try to do everything in one, you're in the middle ground there with the survivorship slat. Stefan, any questions on any of the information we've gone over so far?
Yeah, another one came in and asked what a grantor trust is.
Sure. Every trust has a grantor, meaning someone who creates it and provides the initial funding for it. But not every trust is a so-called grantor trust. When we describe a trust as a grantor trust, we're referring to its status from an income tax perspective. And the grantor trust is unique in that the individual grantor remains personally liable for any income taxes generated by assets held in the trust. So the grantor will continue to pay the income tax on any trust-owned asset transactions. That's a very popular way to create many different types of trusts in the estate planning arena, but especially the ILIT. That is typically a grantor trust.
And another question, how about financed insurance?
Yeah, that would fall under our topic of funding the ILIT. And in the order of operations of where do we find the premiums to fund the ILIT, it's going to depend on the situation, but financing from a commercial lender, what I would call commercial premium finance, has pros and cons. It could be a great way to essentially get a bridge loan where someone's expecting a liquidity event, selling a business or a piece of real estate in 3 to 5 years, and need the life insurance now. So instead they get a loan and they plan on repaying it in 3 to 5 years. So it does have a place in funding an ILIT. It's generally not the first place I look for funding.
Going back to the grantor trust, do you recommend setting one up?
I think that if you're one of the individuals or married couples that faces exposure to the federal estate tax, you should absolutely consider it. I would argue that life insurance is the most efficient way to pay for an estate tax. As I tried to show in that example, the money has to come from somewhere. And people generally don't care about life insurance proceeds. There could be some emotional attachment to other assets in an estate, even stock. So to me, it's kind of a no-brainer. If you're exposed to an estate tax, put together the trust. If you're insurable, get the life insurance policy, and let's figure out some more difficult problems in your estate to solve. Stefan, tell me, were we supposed to go to 2:45 or 3?
I believe it was just an hour long here, just an hour long session.
Because I could start on funding, or we could wrap up. I wasn't sure if this was just a 2:45 or not.
I believe it's just 2:45, but we do have some extension if you're able to go out an additional 15 minutes or so.
Okay. Are there any additional questions that have come in?
Yeah, so there's this one. So the ILIT works in parallel with families A, B, or other trust. Is that correct? We use ILITs to remove assets from the family's estate, correct?
Sure, I agree with that. Yeah, AB trust planning is something different than life insurance and ILIT planning. And very wealthy families are going to have pretty elaborate estate plans. So you're going to see multiple different types of trusts. You can see different partnerships or LLCs. We're just focusing as life insurance professionals on one component of that estate plan, the estate tax plan using an ILIT.
And there's more questions. Didn't you say that proceeds will be buying the estate's assets? Question mark.
Yes, that is typically how the ILIT facilitates the estate tax payment. The ILIT will have the cash from the life insurance proceeds and buy assets from the estate. And a good question I received the last time Sharlene and I presented this material, when the estate sells those assets, in my example, it was those stocks and bonds, that is generally not an income taxable event because those assets received an adjusted basis at the deceased person's passing. So when the ILIT buys assets from the estate, that should not have any significant income tax consequences either.
And the proceeds of the life insurance policy can't simply pay the estate taxes?
No, we don't want that. If that happens, it's very likely that they would be considered an incident of ownership, paying the debts of the deceased to be included in the estate and increase the amount of estate taxes owed. That would be a huge faux pas in planning. Whoever is advising on that, that could be a lawsuit.
That's the last one. As far as
All
right
right.
now, one person asked for you to talk about the funding, but I think that's what you're going to get into now.
Yeah. And yes, to the person who asked about, would I do this or, yeah, I believe so strongly in this planning that if I were an advisor, I would be getting things memorialized in writing. And this is also for the estate planning attorneys that you're working with. Memorialize that you had this conversation about the potential for future estate taxes and purchasing a permanent life insurance policy and that the client declined because you don't want to be on the back end of unhappy beneficiaries in the future. So if I were a financial advisor, if I were a practicing estate planning attorney, I would be memorializing these conversations. And I'll have to conclude here because unfortunately, my daughter is home sick from daycare and Coco Melon has stopped entertaining her. But Sharlene and I are happy to come back and speak with the group more. You've asked some really great questions and I really appreciate it. So thank you so much, Stefan.
Yeah, thank you both.
Yeah, thank you. And I'll get those other pieces over to you, Stefan.
And then somebody asked if there were any crummy provisions. I know you have to run here.
Well, in most ILITs, yes, you are going to find the so-called crummy or withdrawal powers, because the most prevalent way you fund an ILIT is by making those annual exclusion gifts to the trust. And in order for those gifts to the trust to qualify for the annual exclusion, you have to give some people crummy powers. Not all ILITs have the crummy powers. I'd say over 90% will.
All right, and let you run, Sharlene. Somebody asked, what are the ideal customers to pitch this to?
Absolutely. I don't know if Allison's still with us or not there, but really you're gonna look at your clients. Obviously this is a high net worth play for your clients that are in that $5 to $7 million range. I would think it's a good conversation. Some of the younger clients, I think Allison's example there, she had a 45-year-old projected in 30 years, which is, a really good number to be over the $20 million mark. So any of those higher net worth clients sitting there today, it's always good to have a conversation, even if the federal estate tax isn't going to be an option for them, or a problem, I should say, for them. You still look at some of those state estate taxes. And then we didn't even get into it, not the scope of today's conversation, but long-term care, right? So I think got a wide open door for some of those client conversations.
All right, awesome. I believe I launched our last poll question, which was asking if you'd like to receive more information on the estate planning with Nationwide. All right, perfect. Well, I'll close out this poll question. Thank you all for joining us here. Sharlene and Allison, I know that I believe she dropped off, but thank you all so much for all the information out here. And if you do have any questions, feel free to reach out to one of us at IAMS and we'll get you connected, we'll get you going, and we will also make sure that we get these slides out to you. Let us know if there's anything else we can do for you, and thank you all for your time.
Awesome. Thank you.
Thank you, Stefan.
See ya.